Check one. Check one.
Right. Good morning. Last week we were discussing LKAS 12, that is income tax. Right? So in this standard, we have discussed halfway through, not completed, but today I'm planning to complete the standard LKAS 12, LKAS 32, LKAS 32, and LKAS 36. This is impairment, loss, LKAS 32 financial instrument presentation. Those are the things that I'll be discussing today. Right. Before discussing these two standards, I need to complete this LKAS 12 income tax. Particularly through this standard, we were discussing deferred tax asset and deferred tax liability. Deferred tax asset and deferred tax liability. In the tutorial, I think we have discussed 2 practice questions out of 8 practice questions. Right. Now, I would like to give small recap on LKAS 12 income tax standard. Okay, first we were discussing accounting base and tax base, right? Accounting base and tax base. Accounting base and tax base. What do you mean by accounting base? What do you mean by accounting base? Accounting base means the carrying value of assets and liabilities which calculated as per the regulations of accounting or else accounting regulations, right? Carrying value of assets and liabilities. Assets and liabilities. Okay? That is accounting base. These carrying values are calculated based on accounting regulations. Based on accounting regulations. Right? The second one, the next one is tax base. What do you mean by tax base? Tax base in the sense, the carrying value of assets and liabilities which calculated as per tax regulations or legislations. Tax regulations and legislations. Carrying value of assets and liabilities which calculated as per tax regulation or tax legislation. That is the meaning of tax base, right? Then we need to take the difference between accounting base and tax base. Difference, right? This difference we divided into two. Permanent difference, permanent difference, and next one, temporary difference. Permanent difference and temporary difference. When it comes to permanent difference, we are not going to consider permanent difference for deferred tax calculation, right? We were discussing in detail last week, so I'm not going to discuss again because we need to save the time. Permanent difference, we are not going to calculate deferred tax. No deferred tax computation. No deferred tax computation, and one practice question example also completed on this particular permanent difference. So no deferred tax computation on permanent difference. Right. Moving on to the temporary difference. In temporary difference, we divide this one into two, right? First one, taxable temporary difference. Taxable temporary difference. Taxable temporary difference, right? If there is a taxable temporary difference, we need to identify deferred tax liability. Deferred tax liability. Okay? Deferred tax liability. Next one, deductible temporary difference. Deductible temporary difference. Deductible temporary difference. If that difference is deductible temporary difference, we need to identify deferred tax asset. Deferred tax asset. Deferred tax asset. Let me explain these concepts through an example. 31st March 2018. 31st March 2018. 1st of April 2018. This one 17. Suppose Arali entity purchased a motor vehicle, cost 800,000. Useful life, or else depreciation rate, let's say 20%. Depreciation rate 20%. So carrying value on this date, 31st March 2018 is 800,000 minus 20% of 800,000. That means how much? 160,000. So carrying value is 640,000, right? This is the carrying value. So as per the explanation, this 640,000 could be identified as what? Accounting base. So we can write accounting base as at 31st March 2018, as at 31st March 2018 is 640,000. Right? Now we need to calculate as at 31st March 2018 tax base. Tax base. Right? When you learn taxation, you know accounting depreciation is not allowed for disallowable. In other words, disallowable expenses. Right? We need to add back. We need to add back in tax computation. Tax computation we need to add back. Right? So accounting profit. Accounting profit. So depreciation. Now you can understand already we have deducted from this profit. Profit computation. Accounting depreciation already deducted. Right? However, tax computation, this accounting depreciation need to be added back. Added back. Right? That means this 160,000 need to be added back. In other words, for this 160,000, we should pay tax. We should pay tax in this moment, right? If we added back into this column, that means our accounting profit or taxable profit will be increased. Taxable profit will be increased, right? In simple terms, depreciation, accounting depreciation need to be added back and a taxable profit will be increased. Thus, tax expenses will be increased. Okay? However, the tax authorities in the particular country will give some, facilities or capital allowances to the parties who are paying tax, right? Or else corporates, individuals, tax authorities are giving some capital allowances. You can understand, or already you have learned that, right? So capital allowances. So that is based on tax legislations, tax regulations, capital allowances are given. Capital allowances are given. So, suppose capital allowance for this motor vehicle is let's say 30%, right? Let's assume 30%. So, shall we calculate tax base of this motor vehicle 31st March 2018? So, cost is 800,000. Capital allowance, that means we need to deduct capital allowance from this 800,000 in order to calculate the carrying value as per tax legislation. Here 30% of 800,000. How much? 240,000. 240,000 need to be deducted. 30% no, right? 30% need to be deducted. So 460, right? 460,000 is the tax base. 460,000 is the tax base. 460,000 is the tax base. This 240,000 can be deducted here, right? Because that's allowed expense. Capital allowance is allowed expense. That means our tax expense, overall tax expense would be deducted on this. I hope you can remember. Okay? Here capital allowance. Capital allowance. Right. Now what you need to do here? Accounting base is 640,000. Tax base is 560,000. Take the difference. Take the difference. Take the difference. Take the difference. How much? The difference is 80,000, right? Difference is 80,000. Now you should decide. Now this difference is permanent or temporary. Permanent or temporary. What do you think? After useful life, now in accounting base, useful life is 5 years. Tax base, tax rate is 30%, right? 30% means more than 3 years, less than 4 years. In middle, right? Useful life would be, in between 3 to 4 years. After 5 years, accounting base and tax base would be equals to what? 0. That means this difference is permanent or temporary. This is temporary difference. This is temporary difference, right? This difference is temporary. Last week we were discussing permanent difference, and we learned that for permanent differences we are not going to calculate deferred tax asset or deferred tax liability. Right. Here, now this 80,000 not permanent, this is temporary difference. Now we need to decide this temporary difference is taxable temporary difference or deductible temporary difference. This temporary difference, taxable or deductible? What do you think? You need to understand through this example. Understand through the example. Yeah? On the other hand, you can think on this way. In this particular day, 31st March 2018, the difference is 80,000. Temporary difference is 80,000. On this 80,000, do you need to pay tax in future? Do you need to pay tax in future? Deferred in the sense future. Future, deferred. Do you need to pay tax, or are you going to reduce tax expenses in future on this 80,000? Because there is a difference in accounting regulations and tax regulations. Because of that, sometimes tax savings can be seen, sometimes tax expenses increase can be seen. Tax expenses can be increased. Sometimes tax expenses can be decreased because of these differences. Now in this case, in future, what will happen? Accounting base is 640,000. That means in the future, from 2000, now this is 31st March 2018, 31st March 2019, 31st March 2020, likewise, we will be depreciating this asset. However, single rupee would not be allowed for the tax computation. That means accounting depreciation is not allowed to deduct as an expense. Right? That means for entire 640,000 would be taxable. Right? For this entire 640,000, we depreciate based on accounting, but in tax perspective, we need to add back that depreciation. That means we need to pay tax on this 640,000. I hope you understood. We need to pay tax on this 640,000. Okay? On the other hand, 560. Look at this 560. In this 560, now you can understand, in the future, we can deduct this 560 as capital allowances. Right? We can deduct as capital allowances in the future. That means we can reduce our tax expenses in the future. Okay? We have only 560,000. Up to the 560,000 we can reduce tax. Now you can understand the difference is occurred because of this accounting base is higher than tax base. Accounting base is higher than tax base. That means on this 80,000, are we going to pay tax in future or not? Are we going to pay tax in future on this 80,000? So this one is higher. This one is higher. That means we have a tax liability. Why? Accounting base is higher. Accounting base is higher. Right? On this accounting base, we will depreciate. However, tax legislations do not allow us to deduct. Right? So we need to pay tax on this. So 80,000 is what? Taxable temporary difference. Taxable temporary difference. Okay? So in this taxable temporary difference, we need to apply the tax rate, and we can calculate deferred tax liability. Deferred tax liability. Double entry would be deferred tax expense, debit, deferred tax liability, credit. Deferred tax expense debit, deferred tax liability credit. This deferred tax liability need to be recorded under non-current liabilities in statement of financial position. This one, deferred tax expenses, should be recorded in the profit and loss, profit before tax, here tax. Under tax expenses, current tax, over or under provision of tax, and deferred tax. All three together, tax expenses. Then profit after tax. Right? The deferred tax asset. On the other way around, we need to understand. Already we have discussed how deferred tax assets also generated. Deferred tax asset is generated is on the other way around. Accounting basis lesser than tax base. Accounting base is lesser than tax base for the assets. This is, motor vehicle, no? Motor vehicle. For liabilities, again other way around. Right? Okay. Now, can you please go to practice question number 1? Practice question number 1. Practice question number 1 in the tutorial. Page number 87. Page number 87. Read practice question number 1. Okay, did you read the practice question number 1 and try to answer? Let me read the question. An entity has the following assets and liabilities recorded in the statement of financial position as at 31st December 2018. You are given list of assets and liabilities and the carrying value. That carrying value is accounting carrying value, right? Accounting base. Accounting base. Answer practice question number 1. Item accounting base. That means carrying value, carrying value. Property, plant and equipment. Property. Second one, plant and equipment. Property, plant and equipment. This is the first one, this is the second one. Next one, inventory, trade receivables. Inventory, trade receivables. Next one, trade payables and cash. Next one, cash. Cash, right? Now, can you please write down the carrying values given? All are in millions. Property, 10 million. Plant and equipment, 5 million. 5 million. 4 million, 3 million. Inventory 4. Trade receivable 3 million. 6 million, 2 million. Right. Next, tax base. Tax base. Carrying value. Read the sentence. Read the paragraph given. Read the paragraph given. The value for tax purpose of property and for plant and equipment are 7 million and 4 million respectively. Here property 7 million, this is also in millions, 7 million for the property, plant and equipment 4 million, right? Correct? Property 7 million, plant and equipment 4 million for the tax purpose. That means this is tax base. Right? Next one. The entity has made a provision for inventory obsolescence of 2 million, which is not allowable for the tax purpose until the inventory is sold. That means now we are talking about this 4 million. This 4 million calculated after deducting 2 million inventory obsolescence. In simple terms, inventory damaged, right? But tax purposes, that is not allowed. So what is the carrying value? Now, this, in accounting purpose, original inventory value would be 6, deducted 2, then 4 came. But for the tax purpose, this 2 million is not allowed. So what is the carrying value on tax legislation? 6 million, right? 6 million. 6 million. Did you understand? Right. Moving on. Further, impairment charge against the trade receivable of 1 million has been made. Impairment charge against the trade receivable 1 million has been made. This charge does not relate to any specific trade receivable but to the entity's assessment of overall collectibility of the amount. This charge will not be allowed in the current year for the tax purpose but will be allowed in the future. Income tax rate is 30% required. Right. Now, for trade receivable, normal general impairment was calculated for this trade receivable, right? So before deducting 1 million, this was 4 million, right? Because this 3 million received after deducting 1 million. But in the tax legislation, that is not allowed. Okay? But specific impairment is yes allowed. But remember, those legislations would be changed country to country, state to state. Right? So based on the tax legislation, we need to decide. Based on given scenario, general provision is not allowed. So, carrying value on tax base would be 4 million. 4 million, right? Accounting base 3 million, yes, because there is a general provision. Right? But in tax base, that is 4 million. Okay? Right. For trade payable and cash, silent. No information available. So, then you need to think there should not be any difference. Right? If there is a difference, it will be impacted for the deferred tax asset or deferred tax liability. If there is no information on trade payable and cash, there is no such difference. That means carrying value of tax base or else tax base would be equal with accounting base. Now you need to make them for no difference. So trade payable 6 million, cash 2 million. 6 million and 2 million, right? Now take the difference. Accounting base 10 million for the property, tax base 7 million. Here 3 million. 3 million. Taxable or deductible? Accounting base is higher, tax base is lesser. Difference is this. So taxable or deductible? This temporary difference is taxable or deductible? Yeah, this is taxable. I put here stomach. Okay, so this is for the taxable temporary difference. Okay, we'll discuss next one. Plant and equipment 4. So 1 million. Again, accounting base is higher than tax base, so taxable. This is also taxable. Taxable temporary difference. When it comes to inventory 4, 6, 2 million. Difference is 2 million. Taxable or deductible? In this case, accounting base is lesser. Tax base is higher. Yeah? You need to understand. In future, we will be receiving benefits. In tax base is higher than accounting base. So this is deductible temporary difference. So I'm not going to put this symbol since this is deductible. deductible, temporary difference, deductible. These two taxable, right? Then trade receivable. Trade receivable, here 3, 4. Difference is 1. Difference is 1. Here also same explanation, deductible. Deductible. Okay. For trade payable, no difference. Cash, no difference. Take the difference now. Take the net difference. Take the net difference. Now this is the way that we are going to calculate deferred tax asset or deferred tax liability. We need to consider all the assets and liabilities of a business as at date. As at date. Right? For some assets and liabilities, no difference. No problem. Show that difference. 0. 0. No problem. Difference is 0. That means accounting base and the tax base equal. 6 million, 6 million. 2 million, 2 million. But assets like property, plant and equipment, inventory, trade receivables, sometimes there are changes. Accounting base and tax bases could be changed. Right. Now take the difference. Here, taxable part 4, deductible part 3. So what is the net amount? These two figures higher, right? 4 million, 3 million. So 4, 3. Highest one is 4. So here 1 million. Take the difference between these two. 1 million. This is which part? Taxable or deductible? Taxable. Taxable temporary difference, 1 million. Now, you are given tax rate, 1 million. Now we need to calculate deferred tax asset or deferred tax liability. If this is taxable, so we need to identify deferred tax liability. Deferred tax liability equals 1 million at 30%, okay? How much? 0.3 million deferred tax liability. 0.3 million deferred tax liability. Double entry, deferred tax expense, debit 0.3 million, deferred tax liability 0.3 million. This is the double entry. Okay. I think practice question number 2 already we have discussed in last week. 2 practice questions were discussed last week, practice question number 2 and practice question number 7. Practice question number 2 and practice question number 7 already we have discussed. Now practice question number 1 also done. Now can you please look at examples for tax bases? Examples for tax bases. I have given few examples for tax base on assets perspective as well as liability perspective. Liability perspective. Can you please read one by one? Page number 87. Page number 87. Yeah, let me read example number 1. A machine cost 100. For tax purpose, depreciation of 30 has already been deducted in the current and prior periods. And the remaining cost will be deductible in future periods either as depreciation or through deduction on disposal. Revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable, and any loss on disposal will be deductible for the tax purpose. Right? Now you need to calculate tax base of this machine. Tax base of this machine. Cost is 100, already deducted as capital allowance 30. So tax base, very easy, 70. Tax base is 70. Highlight that. Highlight. Tax base is 70. That is easier, right? Already we have discussed similar items. Right. Second one, read. Try to understand one by one. Now here we have discussed trade receivables and trade receivables and inventory. Okay, so every assets and liabilities we should consider tax basis, accounting basis, and take the difference. Right? Items like property, plant and equipment, yes, there are differences. Accounting base and tax basis, there are differences. Most of the times, we need to consider the deferred tax, these differences, temporary differences on property, plant and equipment. However, you need to focus on all other assets and liabilities as well. Right? Think whether there is a difference or not. Right? Okay. Moving on to the second one. Interest receivable as a carrying amount of 100. That means interest receivable. Interest receivable. Now you need to focus on interest receivable account in the ledger. That's the carrying amount of tax accounting base, right? Interest receivable. Something like trade receivable. Interest receivable is not trade receivable. However, you just think accounting base is 100, right? The related interest revenue will be taxed on cash basis. On cash basis. That means once we receive interest income in future, it will be taxed. That means our tax expense will be increased in future, right? Okay? The taxable income will increase in future. Okay? Therefore, you need to calculate the tax base and accounting base, no? Accounting base, already you are given 100. Now they are requesting tax base. Difference, right? Now you can decide as tax base two answers, right? First one would be 100. Second one is nil, right? These are the two alternative answers, no? Suppose you put 100, tax base also 100. Then what would be the difference? Difference would be nil. That is wrong. That is wrong. Now you can understand definitely in future we need to pay tax. In future we need to pay tax. That is obvious. So in this case, tax base would be nil. Tax base would be nil. See, tax base 0. Tax base 0. So difference would be 100. Difference should be 100, right? Difference should be 100. Then only we can calculate deferred tax asset. Deferred tax asset. In this case, deferred tax asset or deferred tax liability, because accounting base is higher than tax base. Tax base is nil, 0. I hope you understood. I hope you understood. right? Moving on to the next one. Third one. Trade receivable have a carrying amount of 100. The related revenue has already been included in taxable profit, tax loss, profit or loss, right? Now you need to understand the tax base of trade receivable. Tax base of trade receivable. In that case, the tax authorities and accounting base, you need to understand the difference. Already now, in accounting profit also, we have recognized revenue, right? Because those goods are sold on credit. What is the double entry? Revenue credit, trade receivable debit. Right? Tax authorities also included them into taxable profit. So what is the difference then? What is the difference then? Accounting profit already included. Because in the tax computation we consider that revenue, no? Revenue minus expenses, we are getting, tax profit. So that profit is recorded here, accounting profit. That means already we have included trade, credit sales into the accounting profit. That's true. On the other hand, tax authorities also allow us to keep that. That means no difference. No difference. That means no difference, right? There is no such future taxes, either taxable or tax payable or tax deduction. No. That means we need to make the difference nil. We need to make the difference nil. For that, tax base should be equals with accounting base. So, tax base 100. Tax base is 100. Accounting base also 100. Difference is nil. Difference is nil. I hope you understood. Very interesting. Very, very interesting. Last one. A loan receivable has a carrying amount. Loan receivable has a carrying amount 100. Loan receivable. The repayment of loan will have no tax consequences. The tax base, since there is no tax consequences, there is no such difference in the temporary difference, right? So make the difference nil. So tax base is 100. Tax base is 100. Okay? Now highlight all four. Highlight all four. Highlight all four examples on asset. Moving on to the liabilities. Moving on to the liabilities. Read liability part as well. Liability part. Okay. Current liabilities, now in this case, on the other hand, right? Opposite thinking. Previously we were discussing assets, now liability side. Current liabilities include accrued expenses. Accrued expenses, that means payable accrued expenses with a carrying amount 100. Accrued expense, accounting base 100. Now tax base difference. Okay, we'll see. In current liabilities, accrued expense 100. The related expense will be deducted for tax purpose on cash basis. Right. Cash basis. What do you mean by that? In accounting perspective, we recorded them on accrual basis. We have recognized as an expense in profit and loss statement. That's why payable account appeared in the financial position statement. Okay? In tax authorities, what they are going to do, they allow us to deduct that expense on the cash basis. That means in future what will happen? Still we have not paid. This 100. Right? Through the cash we have not paid. But tax authorities mention that, yes, you can deduct when you pay the amount, 100. That means you can understand in future we can deduct something. We can deduct something in future. Right? Something in the sense we can deduct this 100 as an expense. Okay? Therefore, in future there is a tax deduction. So deferred tax asset need to be recognized. Therefore, there are also two alternatives. When you think either tax base 100 or nil, right? If you put 100, difference is nil. That means that our initial discussion is not visible on that answer. Therefore, tax base is 100 is irrelevant, wrong. Tax base should be what? Tax base should be nil. Tax base should be nil. Right? Tax base should be nil. Difference would be 100. Because in this case, deferred tax asset need to be recognized. Why? This is a liability, right? Accounting base is higher than tax base. So, deductible temporary difference. Deductible temporary difference. Deductible temporary. This 100 deductible temporary difference. This 100 deductible temporary difference. Did you understand? Huh? Try to understand. Because there is a difference between accounting base and tax base. Accounting base is 100. Tax base, we need to decide tax base whether this is 100 or nil based on the future consequences. Already, I hope you understood. In future, we can deduct some expenses as some value as an expenses. This 100. Why? Tax authorities allow us to deduct expenses on cash basis. Still, we have not paid this 100. but we can deduct when we pay the cash. Right? Therefore, there is a deferred tax consequences, right? I hope you understood. Moving on to the second one. Current liabilities include interest revenue received in advance. Interest revenue received in advance. That is more important. Interest received in advance. Carrying value 100. That's also liability, no? We have collected money in advance. Revenue collected in advance. Okay? In accounting base, we remove them from the revenue, right? Remove from the revenue. That's why we have, separated it as a liability. Revenue received in advance. Revenue received in advance. Okay. Next, continue. The related interest revenue was taxed on cash basis. The related interest revenue was taxed on cash basis. The tax base on the interest received, how much? The related interest revenue was taxed on cash basis. Now you can understand. In accounting perspective, we have received the revenue. Yes or no? We have received the revenue. Right? We have received the revenue. That means in the tax perspective, in the tax here, right? I'm going to explain here. Accounting base 100. Accounting base 100, because in accounting base we recorded on accrual basis, no? Even though we have received more, we are not going to recognize as income. Right? We are recognizing them for the relevant periods. Since accrual basis, there is a liability. Right? However, in tax authorities, that revenue has been identified as what? Income. Why? They recognize them on cash basis. Already they have recognized in tax authorities already they recognize as an income. Why? On cash basis. Right? Now tell me, is there any tax consequences in future? Is there any tax consequence in future? Yes or no? In this stage, you need to decide that. Yes or no? Yes or no? Yes. Everyone can understand. Yes, there is a tax consequences in future. Right? Okay, then now we need to decide tax base, no? Tax base. We need to decide tax base. Right? Accounting base 100, tax base. We can put two things, 100 and 0. 100 and 0. Here difference. We need to make a difference or not? Definitely, we need to make a difference. Therefore, in this case, tax base would be nil, right? Tax base would be nil. In this case, tax base would be nil. Then only we can get the 100 as difference. 100 as difference, right? 100 as difference. Taxable temporary difference or deductible temporary difference? This is also deductible temporary difference. Why? Already we have paid tax on that income. In future we can deduct. Right? Already we have paid tax. Why? It was taxed on cash basis. Already we have paid on that. But because of this difference, in accounting perspective, there is 100 asset. liability. So based on that, we can identify deferred tax asset, deductible temporary difference. I hope you understood. Huh? Okay. Third one. Current liabilities include accrued expense with a carrying amount of 100. Accrued expense here 100. Accrued expense 100. In accounting perspective, we recorded all the expenses irrespective of the payment. For an instance, electricity expenses, we paid 1,000. However, suppose for entire period, the relevant bill is 1,200. Here we record 1,200, right? Not 1,000. We record 1,200, right? Expense debit 1,200, cash credit 1,000, payable accrued expenses 200. I hope you understood. So, in this case, accrued expense is 100. Accrued expense is 100. Since we have recorded accrued expenses 100, we recorded full amount of expense in the P&L. Full amount of expense in the P&L. Right? Now read, continue. The related expense has already been deducted for the tax purpose. The related expense already been deducted for the tax purpose. Now, in accounting perspective also, we already deducted as expense. Right, the full expenses on the tax authorities. In accounting perspective. Tax authorities also saying, yes, you can deduct as an expense. So what is the difference? Right? No difference. So difference would be in this case, difference would be nil, right? Difference would be nil. Difference would be nil. There is no such consequences. So tax base would be 100. Tax base would be 100. Accounting base 100, tax base 100. Difference is nil. No consequences. Right? Last one. Loan payable has carrying amount 100. Repayment on the loan will have no tax consequences. Since there is no tax consequences, don't make difference value. Don't make difference as value. So make difference nil. So tax base is 100. Tax base is 100. I hope you understood. I took more time to explain those examples. Right? For the benefit of you all. Right, now we can discuss practice question number 3. Practice question number 3 and 4. Practice question number 3 and 4. Here in practice question number 3, there is a printing mistake. In third line, practice question number 3, third line, I'm continuing the reading from the second line. The carrying value of the property was 8 million and the revalued amount was 7 million. Revalued amount was, 2 million. Revalued amount was 2 million. Revalued amount was 2 million. Revalued amount was 2 million. That 2 million was not printed. Write down. Yeah. Did you write the answer for the practice question number 3? Answer for practice question number 3. Practice question number 3. Carrying value of the plant and equipment is 8 million. Right? This is accounting base. Now you are given the same class of asset has been revalued. Same class of asset has been revalued. So revaluation. Revaluation around 2 million, right? Revaluation 2 million. What will happen to the carrying value of the asset if revalued? Carrying value of the asset will be increasing. Right? That means accounting base will increase to 10 million. But what is the tax consequence? What is the tax consequence? Even though accounting base is increased, is there any tax release? Is there any tax release? No, right? Even though property, plant and equipment is revalued, there is no such tax relief. That capital allowances are calculated on the historical cost. Okay, so tax base remain unchanged. Tax base how much? Tax base how much? 6 million. Tax base 6 million. Difference. Difference. 4 million, right? 10 million, 6 million. Difference is 4 million. Difference is 4 million. Now, taxable or deductible? Accounting base is higher. Tax base is lesser. Tax base is lesser. Taxable or deductible? Obvious, this is taxable. Taxable temporary difference. Taxable temporary difference. Now there are two rates are given. 35%, 30%, right? I read the practice question number 3. See, in this country, the tax rate applicable to profit 35. Profit 35. And the tax rate applicable to profit made on sale of property 30%. Now in this case, this one property, right? This one property, not on normal sales and the profit. Here, this is property, plant and equipment. So most applicable rate would be this one. Tax rate applicable for property disposal profit. So we'll take this one. This is most appropriate rate, right? If we take 35%, this one applicable for the normal profit and loss. Normal profit and loss. So take this 30% because this rate was given particularly for the disposal profit on property. So take this 30%. 4 million multiplied by 30%, 1.2 million. Deferred tax liability. Deferred tax liability, right? Deferred tax liability. Okay. Next, go to the summary. Go to the summary. No, before that, shall we discuss practice question number 4? Practice question number 4. I already told you practice question number 3 and 4 need to be discussed together. Practice question number 4. Practice question number 4. Quickly. Read it and try to give your answer. Try to give your answer. Let me read the question. An entity has spent 600,000 in developing a new product. Developing a new product. The cost meet the definition of intangible asset under LKS 38 and have been recognized in the statement of financial position. LKS 38, intangible asset. Development cost. I hope you can remember. Local tax legislation allow these costs to be deducted for the tax purpose when they are incurred. When they are incurred in the sense already they have deducted as an expense. Right? Because once they incur cost on development, entity can reimburse, entity can deduct as allowable expense. Entity can deduct as allowable expense. Right? Therefore, they have been recognized as an expense for the tax purpose. Already I explained that. Already they have recognized as an expense for the tax purpose. At the end of the intangible asset is at the year end, the intangible asset is deemed to be impaired by 50,000. Intangible asset deemed to be impaired 50,000. Right? So in accounting base how much? Accounting base how much? 550, right? Accounting base 600,000, impairment cost 50,000, so 550 accounting base. Now they are requesting calculate the tax base of intangible asset at the accounting year end. Calculate the tax base. This one also no need. They are requesting what? They are requesting what? Tax base. Tax base is how much? So more or less, similar things that we have discussed in the examples. When it comes to intangible asset, how tax base is calculated? How tax base is calculated? Now in this case, that development cost expenses already charged as expense, already deducted as an expense, right? already deducted. However, we have an intangible asset. We have an intangible asset based on accounting base, right? Now they are referring tax base. They have given, in property, plant and equipment, sometimes 30%, 40%, 20% capital allowances are given. In intangible asset, in this scenario, what is the percentage given by the tax authority? 100%, right? 100% given. At the time of incurring, entity can deduct as an expense. 100%, right? That means, what is the tax base? What is the tax base? Accounting base. I already written tax base. How much? In this case, tax base, there is a tax consequences. Accounting base, there is a value. Tax base, how much? Tax base, nil, right? See, 100% deducted already. Cost 600,000, 100% deducted already. So, how much the balance? Balance is nil. Balance is nil. So, difference need to be taken as the difference between accounting base and the tax base. Accounting base and tax base. So, answer for this question is tax base is nil. Tax base is nil. Can you please write down the answer? Answer for the practice question number 4. Answer for the practice question number 4. Write down. Tax base is 0. Tax base is 0. Tax base is 0. Because the tax authority has already allowed. Tax base is 0 because the tax authorities has already allowed the intangible assets, the intangible asset to be deducted, intangible asset to be deducted, intangible asset to be deducted as to be deducted for the tax purpose. To be deducted for the tax purpose. Full stop. Right. Moving on to the next part, that is consolidation. Deferred tax on consolidation. Still we have not started consolidation. However, we'll discuss the tax consequences, deferred tax consequences on consolidation. Next week, hopefully I can start consolidation next week. Because of this coronavirus, due to government order and the benefit of all the students, IAS decided to telecast the lecture series through online until further notice, right? Until further notice, for the benefit of the students, right? So hopefully we can discuss consolidation next week. I already told you the consolidation will be started on the 3rd week of March. 3rd week of March. So next week is the 3rd week. So next week I need to complete the balance part of financial instrument, SLFRS 9. SLFRS 9 need to be completed, and once I complete SLFRS 9, we'll start SLFRS 3 business combination. SLFRS 3 business combination, that is consolidation, right? That is our plan. That is our plan. Right? Because we don't know whether the CA Sri Lanka will postpone the examination. We don't know. So we need to complete the syllabus. We need to complete the syllabus, right? That is the objective. That is the objective. I know, the face-to-face learning is more successful. I can understand face-to-face learning more successful rather than this video. However, what to do because of the environment, because of the regulations, rules, we need to do this for the benefit of you all, right? Please try to understand. Try to understand. Right. Now go to your summary. Go to your summary. LKS 12 summary. LKS 12 summary. Take some identify some place where you have enough space to write tax consequences of consolidation. Consolidation. Remember the consolidation details, in detail, we discuss next week. However, today I take you through on the tax consequences of the consolidation, tax consequences, right? Tax consequences on consolidation. Right. Here, let's say company A, company B. Company A and company B, right? Suppose company A acquired, let's say 100%, let's say 100% equity shares of B, right? So now, since majority of shares of company B were acquired by company A, so we can say all these two companies as a group, right? So company A is parent company. Company B is subsidiary company. Company A is parent, company B is subsidiary company, right? Okay? Because company A is controlling company B. Company A is controlling company B, right? So, company A is parent, company B is subsidiary, all together is group. So, for both companies, we need to prepare financial statement that is called consolidated financial statements. Consolidated financial statements, right? Right. In this case, there are some, transactions between intercompany. Intercompany means parent and subsidiary. Subsidiary and parent. Sometimes parent can sell goods to subsidiary company. Sometimes subsidiary company can sell goods to parent company, right? So some transactions are occurred between these companies, parent and subsidiary companies, right? When they sell goods, suppose parent company has sold goods to subsidiary company. In parent's company, let's say, 1 million worth goods sold subsidiary company for 2 million. 2 million, right? Even though they are under one roof, still they are making profit, right? But in parent company, in parent company, how this 2 million transaction is recorded? How this 2 million transaction is recorded in parent company? Sale credit 2 million, receivable account debit 2 million. Right? When it comes to subsidiary company, in subsidiary company that is purchase. Purchase account debit 2 million, creditors account credit 2 million. Creditors account credit 2 million. Right? That is in individual companies. Separate companies. Double entry. Right? But when it comes to the group, you can learn in future, unrealized profits need to be eliminated. Unrealized profits need to be eliminated. Okay? In this case, suppose all the stocks available at the end of the period, the stocks available with the subsidiary company, no? Because of this sale, the stocks need to be recognized. So stocks, suppose everything with the subsidiary company. Right? In this case, unrealized profit how much? 1 million is the cost, 2 million is the selling price. So 1 million unrealized profit. Unrealized profit. Unrealized profit is 1 million. Unrealized profit is 1 million. Suppose stocks are available with the subsidiary company. All the stocks available. In that assumption, unrealized profit is 1 million. Unrealized profit is 1 million. So this unrealized profit need to be eliminated. Eliminated. Now, based on LKAS 12, there is a deferred tax consequences. Deferred tax consequences, right? Deferred tax consequences. Now you can understand individual companies' inventory value, and group of companies, group financial statements, inventory value, similar or different? Similar or different? Group of companies, inventory value would be 1 million because we eliminated unrealized profit, no? We eliminated 1 million. The stock value 1 million. Right? However, in the subsidiary companies, inventory value, how much? That is 2 million, right? Because two separate companies, subsidiary company purchased from parent company. That is the nature of the business. So the inventory value would be 2 million. But when it comes to the group, unrealized profit eliminated. So now you can understand there is a difference. Subsidiary company asset and the individual company's asset different. So because of that difference, deferred tax consequences will arise. Deferred tax consequences will arise. So we should do the deferred tax computation for that particular difference. Right? Okay? So please try to understand. Next week we will start consolidation. But this is starting. Something like this. We need to discuss many things like this. Many things like this. But focus on deferred tax. Focus on deferred tax. On unrealized profit. Unrealized profit. I hope you understood this explanation. Now try to read page number 90. Come to page number 90. Come to page number 90. Take your highlighter. Take your highlighter. Take your highlighter. And read bottom part. Consolidated financial statement. Consolidated financial statement. Read and understand. I already explained. And do practice question number 5. Do practice question number 5. Right. Now go to practice question number 5. Practice question number 5. Page number 91, practice question number 5. Let me read the question. A subsidiary sold goods costing rupees 10 million to the parent of 11 million. And all of these goods are still held in the inventory at the end of the year. Assume tax rate is 30%. Required. Explain the tax implication. Tax implication. Now you can write your answer. Please write your answer. For understanding purpose, subsidiary company sold goods to parent. Subsidiary sold goods to parent. Cost 10 million, 11 million. Subsidiary, the cost 10 million. It was sold 11 million. So unrealized profit 1 million. Unrealized profit 1 million. Okay. Now you can understand how this 1 million is affected for the deferred tax computation. Deferred tax computation. Tax rate also 30%. Right. Here you should calculate accounting base, tax base. Accounting, the consolidated financial statement, tax base is how much? Sorry, accounting base is how much? Inventory, how much? 10 or 11. In the consolidated financial statement, 10 or 11. 10, right? Why? We eliminate unrealized profit from the consolidated financial statements. We need to eliminate. So accounting base is 10 million. But tax base, how much? In the separate financial statement, inventory value is 11 million. Inventory value is 11 million. So tax base is 11. Difference 1 million. 1 million taxable or deductible? accounting base is higher, tax base is, sorry, accounting base is lesser. Accounting base is lesser, tax base is higher. So taxable or deductible? Deductible temporary difference. Deductible temporary difference, so 30%, 0.3 million deferred tax asset. Deferred tax asset. Deferred tax asset. Right. We'll write the description on this answer. Now this is in the calculation part. We'll write the explanation. Answer for the practice question number 5. Unrealized profit of 1 million should be eliminated. Unrealized profit of 1 million should be eliminated from the consolidated financial statements. From the consolidated financial statements. Unrealized profit of 1 million should be eliminated from the consolidated financial statement. The sale of the inventory is a taxable event. Sale of the inventory is a taxable event, and it causes a change in the tax base. The sale of the inventory is a taxable event, and it causes a change in the tax base of the inventory. It causes a change in the tax base of the inventory. Full stop. Full stop. The carrying amount in the consolidated financial statement, the carrying amount in the consolidated financial statement, carrying amount in the consolidated financial statement of the inventory will be 10 million. The carrying amount in the consolidated financial statement of inventory will be 10 million, but the tax base is 11 million. But the tax base is 11 million. This gives rise to a deferred tax asset of 1 million. This gives rise to a deferred tax asset of 1 million at the rate of 30%. Deferred tax asset of 1 million at a rate of 30%. This gives rise to a deferred tax asset of 1 million at a rate of 30%, which is 0.3 million, which is 0.3 million. That means the deferred tax asset is 0.3 million. 0.3 million, not 1 million. 1 million is the deductible temporary difference. 1 million is deductible temporary difference. Apply the rate, then you will be getting deferred tax asset. Then you will be getting deferred tax asset. Okay? Right. Now, next, second explanation. Second explanation. Second explanation. You know, when parent company acquire a subsidiary, parent company pays some consideration. Right? Parent company should pay consideration to subsidiary company, then subsidiary company's net asset. Net asset will be acquired by the parent. That is the thing, right? Happening on the consolidation. Consideration and the net asset. Okay? Suppose parent company acquired 100% of subsidiary company. Okay? Net asset, the fair value of net asset, let's say 100 million of subsidiary company. Fair value of net asset is 100. Net asset means what? Asset minus liabilities, no? Asset minus liabilities, net asset. Asset minus liabilities, net asset. That is 100 million. Okay? Suppose parent company invest on subsidiary company 120 million. Right? 120 million. That means parent company pay 120 million in order to acquire 100 million worth subsidiary. 100 million worth subsidiary in simple terms. So investment 120, fair value of net asset 100 million. So difference between these two need to be identified as what? Goodwill. Okay? Need to be identified as goodwill. 20 million goodwill. See? Investment 120, fair value of the net asset 100 million. Therefore goodwill is 20 million. Okay? Now I need to explain small point. Remember, this goodwill would be appeared in the consolidated financial statement as an asset. In the consolidated financial position statement, non-current asset, goodwill, 20 million. Right? 20 million. In the statement of financial position. Remember, this 20 million could be appeared only in the consolidated financial position statement, goodwill. Now you need to understand the tax consequences on this. Tax consequences on this. Tax consequences on this. Deferred tax. What do you think? Deferred tax consequences on goodwill. Remember, as per case 12, there is no such tax consequences on goodwill. Why? The reason is goodwill is a balancing figure. Goodwill is a balancing figure. Balancing figure in the sense that is a residual figure. No? Investment minus fair value of net asset. In simple terms. We'll discuss further in next week. But for the time being, try to understand on this simple example. This is a balancing figure, right? Suppose if this is changed 110, fair value of net asset change 110, what will happen to the goodwill? Goodwill become 10. Goodwill become 10. So that's why I said this is a balancing figure. If the value of the net asset change, then as a result, As a result, goodwill also going to be changed. So, for goodwill, we are not going to calculate deferred tax asset or deferred tax liability for the goodwill, right? Please try to understand. For the goodwill, we are not going to consider for the deferred tax computation goodwill. Why? Reason is that's a residual figure. That's a balancing figure in simple terms, right? Not only goodwill, we are not going to consider some initial assets, some certain initial assets or liabilities, right? Some assets and liabilities we'll discuss in later, but for the time being, understand this goodwill, that is more specific. Goodwill, no deferred tax, right? Because this is also one of assets in the consolidated financial position statement, asset. So no good. However, no deferred tax. Reason is this, that's a balancing figure, right? Not only that, goodwill, some assets or liabilities in the initial measurement. When it comes to consolidation, sometimes we need to recognize some assets and liabilities as per SLFRS 3. For an instance, contingent liabilities also need to be identified. But as per normal accounting standards, contingent liabilities are not accounted. However, at the point of acquisition, we need to recognize contingent liabilities. So those are the examples. Remember, for some kind of assets and liabilities in the initial measurement, we are not going to do the deferred taxation, right? Third one is some investments with the restrictions. We are not going to consider for the deferred taxation, right? Now go to page number 91. Page number 91. Temporary differences not recognized for the deferred tax. Temporary differences not recognized for the deferred tax. Read this small paragraph and go to practice question number 6. Go to practice question number 6 quickly. Read and highlight, particularly in the goodwill. If you cannot understand balance 2 points, don't worry, because we are discussing in detail on next week onwards. So don't worry. Try to understand this goodwill part in this moment. That is enough for this. In this moment, we'll discuss later about other things. Yeah, now go to practice question number 6. Practice question number 6. Practice question number 6. An entity has acquired a subsidiary. A goodwill arising on the transaction amounting to rupees 20 million. Goodwill is not allowable for tax purpose in the entity's jurisdictions. Tax rate for the entity is 30% and the subsidiary is 60% owned. Now I explain 100% owned, no. But the given example, parent company has acquired 60% of subsidiary's equity, right? Required. Calculate the deferred tax liability arising to goodwill and explain whether a taxable temporary difference would arise if goodwill was allowable for the tax purpose on the authorized basis. Right? Now already you know, as per case 12, for the goodwill we are not going to consider for the deferred tax. That means we are not going to consider for that temporary differences for the goodwill, right? Write down. A deferred tax liability should not be recognized. A deferred tax liability should not be recognized. Deferred tax liability should not be recognized for any taxable temporary difference. A deferred tax liability should not be recognized for any taxable temporary difference which arises on the initial recognition of goodwill any taxable temporary difference which arises on the initial recognition of goodwill where goodwill is deductible for tax purpose, goodwill is deductible for tax purpose, goodwill is deductible for tax purpose in authorized basis. Goodwill is deductible for tax purpose in authorized basis. Comma, a taxable temporary difference, comma, a taxable temporary difference will arise. A taxable temporary difference will arise in future years. A taxable temporary difference will arise in future years, being the differences between the carrying value in the accounts, carrying value in the entity's accounts, difference between in the carrying value in the entity's accounts and the tax base, and the tax base. I repeat the answer for those who have not written completely, or sometimes you have written halfway through. Let me read again. A deferred tax liability should not be recognized for any taxable temporary differences which arises on the initial recognition of goodwill, where goodwill is deductible for tax purpose in authorized basis, comma, a taxable temporary difference will arise in future years, being the differences between the carrying value in the entity's accounts and the tax base. Full stop. That is the answer for practice question number 6. Practice question number 6. Practice question number 7 already we discussed. Last week we discussed practice question number 7. That question on permanent differences. On permanent differences, Already we discussed. Now go to, again go to summary. Again go to summary. Again go to summary. In the summary, identify the place where you have mentioned deductible temporary difference. Deductible temporary difference. Deductible temporary difference. Already you know, through the deductible temporary difference, we need to identify deferred tax asset. Deferred tax asset. This is deductible temporary difference is one method. One method is one nature. When it comes to deferred tax asset, this is one source. One source. That is the real word. This is one source. There are other two sources as well. There are other two sources for deferred tax asset. Other two sources for deferred tax asset. Can you please tell me what are the other two sources for deferred tax asset? Deferred tax asset in the sense, in future, the tax expenses will be decreased. That means, in other words, in future, our tax, there is a tax savings in the future. Tax savings in the future. That's the meaning of deferred tax asset, no? Yeah, what do you mean by that? What are the other two sources of deferred tax asset? Already we recognize one. Deferred tax asset can be recognized based on deductible temporary difference. Deductible temporary difference. Other than deductible temporary difference, what are the other two sources? What are the other two sources? You can think. You can think. You can think. We can reduce future taxes on that. If you have done taxation subject, definitely you can say that answer. Definitely you can. Now, as per the tax authorities, suppose this year we make tax losses. Tax losses. This year there is a tax loss. Can we take that tax loss into the next year? Tax carried forward, can or cannot? Can, right? I think, if I'm not mistaken, 35% of total statutory income we can carry forward into the next financial year, next year of assessment. So, if there is a tax loss this year, we can carry forward into the next years. So, in future, we can reduce tax on that. So, see, there is a tax. In that case, we can identify deferred tax asset. Deferred tax asset. Right? Okay. Second one is that. Third one. Third one. Third one. Third one. Huh? For an instance, let's say withholding tax. Payee tax. Withholding tax, payee tax. What do you mean by payee and withholding tax? Right? Huh? If you have paid already, there are some taxes already paid. Huh? So we can take them in subsequent financial years. Those are called unused tax credits. Unused tax credits. Tax credits in the sense, the taxes which we have paid already. So those taxes can be taken in next or else subsequent financial years. So if we have unused tax credits, we can reduce the taxes in future. So that is the third example, third source for deferred tax asset. Deferred tax asset. Right. Can you please write down in the summary? This is one source. Deductible temporary difference is one source. Second one, Carried forward unused tax losses. Carried forward unused tax losses. Carried forward unused tax losses. And third one, carried forward unused tax credits. Carried forward unused tax credits. Write down. Yeah. Now, can you come to page number 86? Can you please come to page number 86? Highlight deferred tax asset. Highlight. Take your highlighter and highlight the definition of deferred tax asset. Definition of deferred tax asset. Definition of deferred tax asset. Right. Now come to page number 92. Page number 92. Page number 92. Read the first paragraph of deferred tax asset. Read the first paragraph page in the page number 92. The same thing that has been, explained in the paragraph. Okay, now you can read practice question number 8. Practice question number 8. Do practice question number 8 quickly. That's, compared to other questions, big question, big one. Quickly. read the practice question number 8 and try to do the practice question number 8, right? Easy to understand, easy to understand. You should decide how to do the answer, right? The tax legislation has been changed. Tax legislation has been changed. As per that particular change, the differences also need to be changed, right? Temporary differences also need to be changed. Yeah, did you read the practice question number 8? I hope you are answering the practice question number 8. Okay, while you are answering, let me read the practice question number 8. As a consequence of the reorganization and the change of government legislation, the tax authorities have allowed a revaluation of non-current asset for the tax purpose to market value as at 31 December 2018. There has been no change in the carrying value of the non-current assets in the financial statement. Now what has happened? Entity has revalued property, plant and equipment, right? However, the previous example we were discussing, no changes in tax legislation. However, in this case, you are given the tax legislation also changed. Tax legislation also changed, right? So you are given carrying values, existing provision. So we should know the existing provision, no? Existing provision, accounting base, tax base, difference, right? Accounting base, tax base, difference. Property, accounting base how much? Carrying value as at 31st December 2018 in million. PPE and vehicles, no? PPE and vehicles. PPE and vehicles. Right? There are 3 columns, there are 4 columns. Second column, carrying value as at 31st December 2018. Tax base, third column, tax base as at 31st December 2018 after evaluation. After evaluation, underline the word after evaluation. Next one, tax base as at 31st December 2018 before evaluation. Before evaluation. So, now, because we should know what is the deferred tax asset or deferred tax liability. We don't know. We'll calculate first and see. Deferred tax. Fill in the blanks later. Deferred tax. We should know the balance, no? Here or here. There should be a balance, no? Here or here. We don't know. We'll calculate and see. We should find out the balance first. Right? So, accounting base. Accounting base, here 2.5 million. 2.5 million. Vehicles, 1.5 million. In addition to those two items, there is another asset, right? Other taxable temporary differences. Other taxable temporary difference in the sense? Other taxable temporary difference 1.25 million as at 31st December 2018. Other asset. We don't know asset or liability, but you are given here temporary difference. Other taxable temporary difference 1.25. 1.25 years taxable. 1.25 taxable. Don't write on accounting base, don't write on tax base, but write on temporary difference. Taxable temporary difference. This is taxable temporary difference. Okay, let's put the tax base for the PPE in order to calculate the existing provision. PPE tax base before evaluation how much? 2.4. 2.4. Vehicles 1.4, right? 1.4. Take the difference. PPE accounting base 2.5, tax base 2.4, here 0.1. Taxable or deductible? Accounting base is higher, tax base is lesser. So, taxable. Taxable. This is taxable. Taxable. Here also 0.1 million. 1.5 minus 1.4, 0.1. Here also taxable, right? Because accounting base is higher than tax base. Accounting base is higher than tax base. We'll discuss this. Okay? I hope you understood up to this point. Now take the total of this. How much? 1.45, right? 1.45 million. All are taxable temporary differences. All are taxable temporary differences. This one taxable temporary, this one also taxable temporary difference. So 1.24, 1.45 million taxable temporary difference. What is the rate given? Rate given is 30%, right? Yes. Assume the income tax rate is 30%, deferred tax provision 31st March, and had been calculated using the tax values before revaluation required. Show the impact of financial statement for the above. Right, okay. Now, deferred tax liability is 1.45 million into 30%. How much? 0.435. So, deferred tax liability balance carried forward for 0.435 million. Right. Deferred tax liability. Deferred tax liability 0.435. Okay. Now, new amendment, right? Accounting base, tax base, and difference. Accounting base, tax base, difference. Accounting base, here PPE, vehicle, other. Accounting base 2.5 remain unchanged, 1.5 unchanged. You are given other taxable temporary difference 1.25. Please write the similar value. But tax base is going to be changed. After revaluation, tax base is going to be changed. 3.25, here 3.25. 3.25, here 1.75. 1.75. In this case, what has happened? Accounting base is lesser. 3.25 minus 2.5. 0.75. But this is deductible temporary difference. In this case also 0.25 deductible. Right? Here 1.25 remain unchanged. Here 1 million, here 1.2 million, together 1 million, here 1.25, this is taxable. Taxable, no? This is taxable. So, what is the net value? 0.25 million. 0.25 million, right? 0.25 million, this is taxable. Because this is higher. 0.25 million, taxable temporary difference. Okay? So, apply the rate. Deferred tax liability 0.25 million at 30%. How much? 0.075 million. 0.075 million. 0.075 million. This is the updated figure. Okay. This should be the updated figure. Balance carried forward. Right. Here balance brought forward. Sorry, balance carried forward. Here balance brought forward. Balance carried forward 0.075. Balance brought forward 0.075. 0.075. Now you can see the difference. Here the higher side is this side, credit side. 435. Take the balance and charge to the P&L. Take the balance and charge to the P&L. $0.36 million. 0.36 million should be charged to the P&L. Please try to understand this. This is very easy. This is the impact. This is the impact on deferred tax changes into the P&L. 0.36 million. 0.36 million. Right? Okay, I hope you understood this answer for the practice question number 8. Okay, now we'll take a small break. We'll take small break. After small break, we can continue practice question number 9 to 10. The beginning I told there are 8 practice questions, but sorry, there are 10 practice questions in the tutorial. So we'll discuss balanced practice questions after the break.